So we are going to discuss the economic effects of digitalization this afternoon. Let me tell you a little about the panel. Südekum is Professor of International Economics at the Düsseldorf Institute for Competition Economics. He is a specialist on global trade, digitization, and labor markets. He has been an advisor to the World Trade Organization, the International Monetary Fund, the European Commission, the German federal government, and the Bundesbank. We also have Lori Rennison. She's a Senior Policy Director in the International Department at the Bank of Canada. She is part of the senior leadership team overseeing the bank's analysis of global economic developments relevant for Canada. She has been the chair of the G7 Central Bank Working Group on Digitalization and conducts and oversees policy analysis and research on a range of economic issues important to monetary policy. Yael Selfin is chief economist at KPMG in the UK and a fellow at the National Institute of Economic and Social Research. She has been advising clients on the global economic outlook and its impact on their strategy for over 20 years. She has worked on new technologies and Brexit and has looked at ways to lift growth across UK regions. So let me turn the floor over to Jens to start us off, and we'll go one at a time.
Thank you, Don. Thanks for the invitation. So I'm going to talk mainly about the labor market effects of digitalization, and then hand over to my colleagues who talk about different issues. And I mean, the labor market effects are very high on the agenda of many people, especially in the popular press, where you hear all these stories about robots taking away all of our jobs, and we all suddenly will be unemployed, right? And I think there are two approaches to address this question. One is this sort of speculation about the possible effects of technologies that don't yet exist, but or which are not yet widespread, and you speculate what could happen. And you know, as an academic, I prefer the other approach, which is going to empirical evidence and analyze what has actually happened in the labor market in response to new digital technologies that already exist for some time, right? And that means that, of course, you cannot talk about the most cutting-edge type of technologies like AI, full-blown AI, because they're not widespread, and so there's no way how you can talk about the actual effects and empirical evidence. So, but in my work with my colleagues, we looked at industrial robots, which most of you will be aware of, and that's technology that exists for 20, 25 years already, and you can combine that data about the usage of industrial robots with labor market data to actually find out what are the implications in terms of employment, in terms of wages, in terms of redistribution. And so I just want to briefly talk about our research there. And the first sort of paper that we've written on the subject follows a line of research that Darren Acemoglu at MIT came up with. So he was the first to study the labor market effects of robots, essentially using the same robot data set in the US. And so the main result of his work was that actually there are quite severe and negative effects in the US labor market. I mean, nowhere near this dystopic stories about half of all jobs being gone, but still, I mean, they found, Acemoglu and Restrepo, that in the US there were negative effects on labor force participation, and the rule was that a robot destroys roughly 6 full-time jobs, every robot, mainly in the manufacturing sector, but with very little compensating effects in the service industry. So it was a pretty sobering picture that they've painted. And so basically we got motivated to look at the same issue for Germany. And Germany is a very interesting country in that respect, simply because we have many more robots than the US. So in the US you have 2 industrial robots per 1,000 workers. In Germany you have 8, so 4 times as many, which is of course a reflection that the manufacturing employment share in Germany is much higher. Industrial robots work mainly in manufacturing. But even if you compare robots within the manufacturing sector, or you can even go narrow and say robots in the automobile sector, Germany is much more robotized than the US. So you may expect that if there are these negative consequences, they just should be much more severe in Germany than the United States, simply because we have many more of these animals, right? But it turns out, and I should say another advantage of our data set is that if you compare the quality of German and American labor market data, usually the German data is much more detailed because we have this social security system which essentially allows us to follow the careers of workers over time very closely, which is not as easily possible in the US. And so it turns out, if you do similar analysis for the German labor market, that the effects of robots from 1994 till today are actually much less negative, or you could say even positive in response. So the same technology shock has created very different reactions in the American and the German labor market. So what we find is that there is actually a negative effect of robots on manufacturing employment, as you would expect, right? I mean, if you just envision all these production lines where formerly you used to see humans building a car, and now you basically see only machines building a car, of course you would expect that jobs in the manufacturing sector have gone down, and robots have been a driver of this, and that's what we find. Our number is roughly 2 full-time equivalent jobs in the manufacturing sector that disappear for every robot that is installed. And there's some variation in robot usage across different manufacturing sectors. Right? So the automobile industry is the most robotized, and then there's wide variation across different manufacturing sectors. And so we do find a negative impact on manufacturing employment. But in the German case, it's fully offset by an equivalent number of new service jobs that are created, causally speaking, because of robots. So basically, it's a zero when you calculate the overall impact of robots on total employment in Germany. You could still think it's disruptive because you have minus 280,000 jobs in the manufacturing sector, roughly speaking, because of increasing robotization. But what we find, and that's the advantage of this individual level labor market data that we have in Germany, the really good news is that at the individual level, we did not find any evidence for displacement or an increased risk of unemployment. So it was not the case that a robot is installed and workers were fired because of that, but what we find is actually that the workers were retained at their same workplace, essentially, and they changed occupations, they changed the type of tasks they performed at the labor market, and they kept their jobs, and only when they reached retirement age, at that point, the vacancy was no longer filled. Right, so over the long term, robots displaced jobs, but they did not lead to disruptive displacement of individual workers. And that also means, as a corollary, that manufacturing workforces, they have been aging, relatively speaking, because you kept and retained your old workers, and there was a smaller inflow of young people into manufacturing sectors. But the young people, they started in the service industry, and there was no shortage of work and jobs in the service sector. Now, service sector can mean very different things, right? So it could be finance and banking, so good service jobs. It could also be McDonald's type of bad service jobs, but it used to be typically the good type of service jobs that the labor market entrants entered when they started their careers. So that's really the good news, that apparently in terms of the labor market effects, the German labor market sort of seems to have digested that technology shock actually better than the American labor market, which could be surprising because you tend to think the American labor market is flexible and the German labor market is rigid. But actually we think that the characteristics of the German labor market were actually key to understanding why there have been so essentially zero direct displacement effects. I think it's also because of the corporatist approach that is very widespread in German manufacturing. So trade unions, works councils who have a very high priority of stable jobs for the incumbent workers. and are relatively flexible when it comes to finding solutions at the firm level, how to stabilize those jobs. And apparently this has worked. And because of this, because there was no job destruction because of the robots, especially at the local level, probably that's why there were relatively few negative spillovers into local service industries, for example, which Ashimoto and Rissmiller have found for the US. So this is the good news. But now the bad news, and I think this is also relevant for monetary policy. The bad news you see when you look at wages and earnings, because even though jobs were stable, that doesn't mean that earnings reacted positively to that technology shock. So what we find is there were notable positive effects on productivity at the firm level and also profits, but not average wages. So we have seen an increasing gap between productivity and wages. Average wages remained essentially flat, whereas productivity increased, which means that there was a falling labor share in response to that technology. Coming back to that in a second. So at the individual level, even though average wages remained flat, there were some reactions. So high-skilled workers with a university degree in technical occupations, management occupations, the legal occupations within the firm, they tended to gain. Low-skilled workers, janitors and so on, there was no reaction. But in the middle of the spectrum, so workers with completed apprenticeship, they tended to actually lose in terms of real wages, which means nominal wage increases below inflation. Right? So, and that's overall basically flat average wages, but with a redistribution within the group of workers. Right? So it's really this pattern of skill-biased technological change that we've seen, or polarization, that the middle type of skills that they lost in terms of real wages. And when I say middle, I mean the medium skilled. I'm talking about 75% of all manufacturing workers have that profile, whereas high skilled workers are roughly 10%. So the overall pattern is that basically this technology created rents for capital, but not for labor, because average wages have remained flat. So in very new and recent research, which is a paper that will probably come out next month or so, we now looked more at the firm level, and what we find is now for Europe as a whole, for European manufacturing, that we actually do find the pattern that is known as the superstar firm pattern, which other authors have found for the US, which means that within an industry, you have a distribution of firm productivities, and then if you look at productivity growth as a function of the initial productivity level, you tend to find that in many industries, it's actually the most productive firms who are already at the right tail of the distribution, they had the highest productivity growth, and they were increasingly forging ahead of the others. So that's the superstar pattern, and if you hear that, you immediately think, well, that's Amazon and Facebook and so on. So the digital companies in the US, where there's a clear reason why in those industries, because of network externalities, where you tend to expect a move towards monopolization. Now, actually, in Europe and in European manufacturing, we find a similar pattern. Not in all industries, but in several industries, we have that superstar pattern. The best firms, the most productive firms, getting even more productive and increasing their markups, their profit margins, whereas the less productive firms have almost zero productivity growth and had to decrease, lost market shares, and had to lower their markups. And the key finding of our paper is that a higher degree of robotization, or you can call it digitalization, actually reinforces this superstar pattern. So you tend to see more of this superstar pattern, this kind of winner takes all or winner takes most picture in more digitalized, more robotized industries. Right? And recently there has been a discussion how that feeds back into low investment and low productivity growth for the economy as a whole, right? Because, this is not something that we investigate in detail in the paper, but I think the relation is pretty clear, that if you have this superstar pattern and you are kind of a firm in the middle of the road, and you see the superstar firm in your industry forging ahead, this may be a huge disincentive for your own investment, because kind of the perception seems to be that it will be very, very hard to catch up with this superstar firm, which in turn could imply low investment and low productivity growth for the economy as a whole. And so this is kind of what we do find in our paper, at least when it comes to the superstar pattern, also for European manufacturing. So I think there are certain policy implications that fall out of that, and which we may discuss later on. Right? So the real problem of digitalization in the labor market is not mass unemployment or employment effects, but it really, the most difficult aspects are when it comes to the distribution of rents, right? So wage distributions, income distribution, and it's mostly the functional income distribution, because what we found is that this increased robotization tended to decrease the labor share, right? Because also the superstars have the lowest firm-specific labor shares. They pay in absolute terms the highest wages, but in relative terms have the lowest labor share, and then if there is an intra-industry reallocation of market shares towards the most productive firms, this tends to decrease the labor share, right? And if most of the rents go to capital, right, or the owners of robots or the owners of the firms that use robots, then the ultimate question is who will generate earnings out of this, right? And we all know that capital ownership is very highly concentrated in the top 10 or maybe even top 1% of the wealth distribution. And then this effect that I've just described on the functional income distribution can translate into the personal income distribution if capital earnings in the longer term tend to increase, whereas labor earnings or the labor share tends to decrease. So I think the key issue for policy is how to deal with this effect on the distribution of income, which can be, very hard if, let's say, the new or the next wave of technologies will have similar effects, right? So if that will be the case, I don't know. I mean, that's speculation. If basically the labor market will react to AI or to big data and so on in a similar way that it has reacted to the rise of the robots. But if it does, and that's kind of my informed speculation, I mean, if I have to speculate about what will happen in the future, I try to kind of start with what we've seen in response to the robots. And well, if that happens, then we're going to face a problem when it comes to the distribution of income, and we better kind of have a discussion about possible solutions before the problem gets too acute. Okay, thank you very much.
Thank you very much. It's great to be here, and it's great to follow Jens because I'll have a lot of similar themes that will run through my presentation as well. I am going to speak from the perspective of certainly as a central banker, but also as a chair of a working group that we set up under our G7 presidency last year when Canada had the presidency. And one of the issues that was a theme for us was on the adapting to the modern economy, and so that's something that both finance ministers and central bank governors were speaking about. And we realized on the central bank side that there was a lot more questions than answers, and any of our individual attempts to kind of quantify it was challenged by measurement, and we were kind of struggling to be able to say just how much digitalization was affecting the economy now, but knowing how important it was for the future, and that this was a source of uncertainty that central banks were facing, this technological uncertainty, and the importance of investing to better understand that. So we started a working group, and there's some members here, so Jens is a member of it, and Johannes was also part of our discussions last year, or during this year and last, and we have a report that we submitted to governors, G7 governors, that kind of tries to help frame their thinking around this, and how we should be thinking about it, and where we think that we need to push more, and that's going to be published soon, and so I'm speaking to the themes that were in that work, So I'm going to focus on three things. First, why digitalization matters from a monetary policy perspective. Second, what are the risks of waiting as we wait for greater clarity around how digitalization is affecting and will affect the economic and financial relationships on which we base our policy decisions. And then a few reflections on what are the implications for how central banks work that I'll draw on from the Bank of Canada's experience. So My next point is just that these views are mine and do not necessarily reflect those of the Bank of Canada's Governing Council, which I always say. And I'm going the wrong direction. Okay, so I'm going to put some very easy pictures to look at for your afternoon, so there won't be any equations or graphs in mine. But so when we think about the world going more digital, and Jens talked a little bit about this, part of it is something we are seeing, and part of it is speculation still. But I think it's useful to think about what we mean by digitalization. So as a basic idea, the shift from analog to digital in the way that we record and process information, and this can come through in both the technologies that enable that, so the equipment that enables that digitalization, so IT equipment, but also the activities that are highly associated with it, so e-commerce or the digital delivery of goods and services, and the transformation in the way that consumers can buy, where they buy, and how much they pay, and then businesses, how they operate, and how they set their prices, and how often is all changing as there's more digital connectedness. And this has been happening for a while, but from what we're seeing, the pace seems to be accelerating and is expected to continue to do so. And then the recent advances in areas like AI and machine learning, while still speculative, they have the potential to change how economic activity is structured and how decisions are made in a way that could disrupt more industries, including our own as central banking. So there's kind of a few shifts if we think about things we're already seeing. This picture on the top left that has the ones and zeros, the more digital kind of world that's already in activity that we're already capturing, and then shifts as things move toward the cloud is an example. I think what we're seeing is all activity is becoming more digital. The way that we've been able to quantify this, both work done by the U.S. Statistical Agency and also ours in Canada, to try to use satellite accounts to extract the digital activity that's already captured in what we can measure in GDP. And so that work shows that the digital activity is as large as some of the more traditional sectors of the economy. So in the case of Canada, it's larger than, the digital activities component is larger than our mining, oil, and gas sector, which is a pretty important sector for Canada. And then the second point is that with the transfer to the cloud, that more and more firms are using these cloud services, and the investment by companies that are providing cloud or telecom services has reached new highs and has rivaled the telecom investment of the 1990s. And so as we're seeing that shift, it's a change for firms that would normally do maybe invest in their own servers that are now able to access the cloud, and so the nature of investment is also changing in ways that are important for us to understand. Then on the consumer side, with the consumer capital, digital capital, where the delivery of digital services through phones or through other consumer devices has really gone up rapidly in the last 15 years. So when we think about maybe in the 70s to the 95, we had a VCR, we had cable, we had a few things, and if you map them out, there's a bit of time in between. And then over the last 15 years, we've kind of been hit by increasing kind of consumer innovations that are, whether it's smart TVs or streaming or all these things that might individually seem small, but they're actually providing a lot of benefits to consumers that that either were paid for before or that they didn't exist before, so it represents a quality improvement. Then there's the Internet of Things and the more connectedness between machines, and underpinning a lot of the activity is machines speaking to each other. And then on the AI and machine learning, as I mentioned before, that's hard to anticipate where that will go. It makes the cost of predicting things cheaper, and so when we know when the cost of something gets cheaper, people or firms tend to do more of it. It affects the demand for complements and substitutes. We had someone speak to our group from the University of Toronto who's an expert in the economics of AI, and Avi Goldfarb, and he gave an example of if you were to go into a library in the 70s or 80s and ask them what they thought the the industry of the future was going to be, that probably they wouldn't have said library science, but in fact, that's what Google has essentially become, where it's extensive searching that happens much more than I think people would have gone into libraries to find out information. So it's one of those ways that once things become easier to do digitally, it's hard to anticipate how they will affect industries. So those are things that we're thinking about, but one thing that we know is clear is that with all that's changing, measurement is lagging, and to some extent this has always been the case. So as technology evolves, statistics are always going to be behind. But the work that we've seen is suggesting that the importance of this gap is growing. It was certainly easier to measure traditional sectors where you can look at the machinery and equipment or count the durable goods coming off of assembly lines, but it's harder to measure the impact of a company using technology to streamline its processes or move service to the cloud, or the impact of free services that are coming through to consumers and providing benefits. But if we can't measure these things, it makes it more challenging to understand the impacts on businesses and people. So there are a number of missing pieces. There are a few that are important from a monetary policy perspective, and we focus on 4 of them. So the first is inflation. Obviously, for inflation targeting central banks, this is critical. Research shows that what exposure to online markets makes prices vary more strongly and more often than assumed in typical monetary policy models. And measuring prices is more challenging when new goods and services are developing rapidly, products and prices can be easily customized, and quality is changing. Inflation baskets aren't updated frequently, so I think it varies from maybe 2 to 4 years across countries based on what we've seen. And then a lot of, when you're dealing with things that are provided for free and there's not a market transaction, but it's providing a benefit, that's harder for price collectors to capture that. There was some work that was done by our colleague at the Federal Board of Governors, Federal Reserve Board of Governors, and he found a way to take into account these consumer digital services, and if you do so, you see that the price indices, a quality-adjusted price measure shows that the price declines have been understated materially. If you were to include this, inflation would be even lower, at least for those components that are affected, and the productivity, the U.S. productivity and growth slowdown would be less pronounced than what we've seen. So it helps to give us a sense of just how big the potential size of mismeasurement can be. And then there's an investment, as I mentioned. The nature of investment is changing from more tangible to intangible forms, and we're still trying to catch up with being able to capture those intangible forms of investment in our national statistics. We certainly hear a lot from businesses. They're devoting increasing amounts of their budget to investing in technology, business processes, and software. We're seeing that still, but what we can measure has gone up even as trade uncertainty has weighed on investment globally. But there's still a lot that's not measured, and we haven't seen the benefits in productivity yet, and that's either because some of the productivity gains are still to come, or that there's some lagging in measurement that matters. One area of investment that we know matters more is data, and the use of data all around the world has gone up exponentially, largely due to the ease with which information can be captured now and converted to a digital format, stored and used to extract knowledge. Our statistical agency in Canada has recently released some experimental estimates that try to put a value on this data. It's something that hasn't, the data gap wasn't as important in the past, but as companies are increasingly investing in data, it's easier to store, it can be used as an asset, and companies know when they sell their business, it will be, they know that data is worth more. And also, we've seen in the cases of some firms, like superstar firms, where user data can become a source of monopoly power. So this data is important, but it's not currently measured or in national statistics. So these experimental estimates that our statistical agency came up with show that it's significant and as big as investment in machinery and equipment, but it's not currently being included in our national accounts. And they're hesitant to do that until there's an agreement on how you value this data, because obviously there needs to be an international dialogue on that. And so it just raises the importance of these international discussions and collaboration on how do you put some of this new activity into our accounts that we will use in conducting monetary policy. Finally, on activity, an example here is Uber, but technology makes the existing capital in the economy more flexible, so platforms can bring idle capacity to bear and creating kind of capacity out of unused or underutilized assets. And so these kinds of platforms are also not well captured, and they challenge our thinking about what is potential output and capacity pressures when you can essentially use existing capital more flexibly than you could in the past. So there are many facets of this that affect monetary policy. It's a live issue, and the economics literature is still working through it. But we know it has the potential to significantly boost productivity. It makes it easier for firms to predict future costs and their demand for their goods, and prices can change more easily, meaning they can be more sensitive to economic activity. But it also has the potential to alter the distribution of income, as Jens was talking about, and market power. And from this, we could see changes to the transmission of monetary policy and the risks associated from the effective lower bound. And this touches on what the theme that I think of as a theme that we heard earlier about the equilibrium rate of interest. And digitalization, the way in which it unfolds, has implications for how that will evolve. And we know that the real neutral rate of interest has been falling across G7 countries and more broadly. And gauging its future direction is particularly important right now, as whether it goes up or down determines the room that central banks have to maneuver in the event of a shock. And digitalization is a positive trend that is happening already and has the potential to raise it, but there are alternative paths that this can follow. And so from one of our objectives was to lay those out for policymakers to be thinking about. These are the two, there's at least two ways that this can go, and there are lots of options in between. But if we think about one path, it's that borderless technologies reduce barriers to entry, increase global competition, and make markets more contestable. So productivity under these conditions should improve. Businesses increase their demand for capital. That helps increase our star. Although businesses can access shared capital now more than, so it may be that it increases less than it would have in the past, but it's still in a positive direction. And higher trend growth means more wealth to share broadly, and monetary policy has more room to maneuver before hitting the effective lower bound. But then there's an alternative path where digitalization creates the winner-takes-most firms. Superstar firms can exert market power, and then under conditions of market power, we see less investment, and that would put downward pressure on our star. And we have seen that markups seem to be rising in digital firms, although it's not clear whether that's lower competition or the nature of the technology is fixed costs because of high fixed cost of developing the technology while operating costs are low. Automation could also hold down the wage growth for low and middle skilled workers, as well as was being discussed by Jens. And the adjustment period as workers that are displaced that can reskill and move into other jobs might be longer than we expect, and a less even income distribution would of course affect the transmission of monetary policy and and could further hold down our star. So given these two paths, and we know it's risky to live with digital uncertainty for any more than we need to, because it creates the potential for monetary policy errors. So what are the steps forward? So of course, better measurement is key, and it will become increasingly difficult to guide policies if we're not able to capture, depending on how quickly the digitalization, some of the new technologies spread, and if we're continuously not capturing parts of activity that are meaningful, this will work against our ability to conduct policy. There are a lot of domestic and international efforts on better measurement now, so it's a question of encouraging that work and also trying to do more within ourselves, within central banks, to be able to use new technologies to get insights on what we can't measure well. And then secondly, policy needs to keep pace with technology to make sure we get more benefits than costs. But without the data piece, it's harder. It's going to be harder to ascertain that. And finally, a couple of words on the implications for central banking. This is not what the Bank of Canada looks like right now, but we are moving towards adopting more of these technologies ourselves to be able to do our jobs better and to be able to develop new tools that can use non-conventional sources to better understand what the changes that are happening and emerging and changing behaviors that affect the way that the economy is functioning. Also, there's a value in having more diversity, developing teams with multidisciplinary talents, given that there's more that we're trying to understand than maybe just traditional economics ways of thinking will tell us. And then the importance of collaboration with the private sector, and I think there's more and more of that happening, not just in the certainly in the fintech space, but as well in terms of how central banks are working with the private sector to draw them in to help us be able to leverage new technologies that they're using to be able to inform our work so that it's not happening in silos, given that given that some innovators are closer to some of this than certainly we are in our central banks. So that's everything. Just the main point of our working group, and that I think is important in thinking about the economic effects, is the need to better understand them, and then the need for policy to be able to keep up with them.
Good afternoon. I'm going to take a slightly different angle, and I'm going to talk primarily about the evidence that we at KPMG find from our clients and looking more at survey-based data. But I'm very much going to start by very much resonating what Jens and Laurie were saying earlier on, where it is really difficult to foresee what the new technology is likely to be, and not only foresee that, but actually try and anticipate how businesses are going to embed new technologies within their businesses. But nevertheless, I'm going to try. But before that, I just wanted to look a little bit at historic data and very easy trends to highlight two key themes. One of them, that if you look at the longer time period, you see that productivity has risen a fairly smooth path, and a lot of it was down to technology. Obviously, we have the blip primarily in the UK. And you don't have the countries here, but I assure you UK is the worst one, and you could probably guess which one is the stronger performing one given where we are today, and which one is okay-ish. It's a quiz for later. And this is very much a UK, this is proving to be very entertaining. This is UK data, and it looks at the three major industries with manufacturing, agriculture, and services. And as you can probably imagine, we've seen a decline in the share of employment in manufacturing in the UK, largely as a result of the increase in productivity and trade. So overall, if we just want to sum up two of the impacts of technology so far, we've seen a rise in productivity largely over time, as well as a shift in the concentration of labor, and I say a shift very much echoing Jens' thought, rather than a decline in the overall use of labor. So, starting now to look at the future rather than the past, I really wanted to spend a few minutes today looking at a number of technologies, just focusing on 5 types of technology. Some of them are new, some of them are old, but we'll see potentially a rise in them, and see how they could impact a number of sectors as well as trade going forward. So a lot of it is relatively experimental, and please bear with me, and I'll try and enlighten you as much as possible, given of what our clients and what business is telling us at the moment. So starting with transport and logistics, there's probably 3 stages to that, with electric vehicles adoption, the autonomous vehicle adoption, and then the development of the mobility as a service that we're seeing as the future for this sector. And the overall impact is likely to be a lower cost of passenger transport as well as logistic, and some transformation of industries, for example, example, as like insurance and industries that are related to car services, fuel station, etc., and overall a potential lower demand for labor. And looking at specific segment of this, and starting with the electric vehicles, and again, I've got some UK data for you here in terms of where the adoption is likely to be. We're expecting a fairly steep adoption curve for electric vehicles, with almost 70% of new cars by 2030 being electric in the UK. So that's quite significant, and so I'd say the main impediment for adoption of electric vehicles at the moment is the cost of batteries as well as the duration of that. So it is very much a technical issue there that we are expecting improvement there. And then when it comes to benefits, probably one of the main benefits is the positive environmental impact that it has, but it also has impact in terms of the reduction of cost, given the engine technologies is likely to be much simpler. It will require some investment, and some of it will be public investment, but it's nowhere near the fiscal expansion that we've been hearing earlier today. I mean, just to give an example, in terms of UK, the estimation is that the government will need to invest around 5 billion, which is really pocket money compared to what they're planning to spend at the moment, although they may have less fiscal room to do that. So generally, relatively positive outlook there, but where I think it is becoming a little bit more exciting in terms of the impact on the economy also, and also personally in terms of my driving preferences, is autonomous vehicles, where we really look at this technology in terms of 5 different stages, with the first stage being relatively limited driver assistance, with things like assistant parking, etc., going all the way to stage 5, where you have no intervention by humans. So at the moment, we're very much in between stage 1 and stage 2, so this is really early days for us, but we're still observing a rise in consumer surplus, even at these early stages of the process. And then looking ahead, the adoption of the higher level of autonomous vehicle is likely to be much slower. These, again, just estimates for the UK, so we're not likely to see such a quick pickup given the complications around it. But when it comes to the benefits, I know you may be a little bit skeptical about the first one, but I think it is really important to bear in mind that when it comes to car accidents or road accidents generally, a very large proportion of it is due to human error. So one of the top benefits of autonomous vehicles, once we get technology sorted, is a much safer environment for transport, and that would have the secondary impact of not only much reduced cost of insurance, but actually potentially a whole refiguration of the insurance industry. We're also likely to see an increase in the efficiency of transport and logistics. Some of you may have heard of the example of platooning, where you have trucks driving together and causing a reduction in air resistance and saving fuel. But generally, the driving is likely to be much more efficient and better when it comes to the usage of fuel and the usage of overall the mechanics of driving. We could also see things like 24 use of vehicles with quite a lot of the logistics and the merchandise traffic being done overnight. We'll need less vehicles for that. We're going to have a more efficient use of capital and also a more efficient use of road infrastructure as a result of this, and also less congestion when we look at the normal working hours traffic during the day. So generally, I think it has many benefits in terms of the implication for the economy. And equally, the other area where I personally quite excited about is, if you like, the third stage of mobility as a service, where I've got some adoption figures for you again from the UK in terms of the expectation, that is quite similar to what we expect for autonomous vehicles. So this is, again, something that we'll see more in terms of the mass impact later on. But we already have Uber and other mobile platforms that give us a little bit of a preview of what mobility as a service could allow, and we also see reports of lower vehicle ownership and driving license take-up among young people that is less than what we've seen overall. So there's definitely a start there, and there's an indication this is something that is going to be picked up. And then in terms of the benefits of it, we are likely to see, if you like, a little bit of a refiguration of urban space with more space that was previously taken up by parking available for potential recreation and leisure use. We're going to potentially also see lower take-up of public transport, and again, just very similar to autonomous driving, we're going to see an increased utilization of vehicles and potentially a requirement for lower number of vehicles overall. Which means that together all these technologies are likely to see the less capital tied up in vehicles and logistics and infrastructure, and allowing capital to be used elsewhere. We're likely to see lower cost. We're also likely to see less labor used in these industries. And what I personally find very interesting is we could see, if you like, a reshape of both the urban and the suburban landscape of many countries, with more people living further away from where they work, and more people choosing to have their second homes or their short-term vacations further afield than what they do now, which, just to give you an example of the UK, what it means is that certain regions, for example, like Lake Districts further north in the UK or Yorkshire, could benefit from what we call as increased consumption or tourism associated with very short breaks or second homes. So the implication in terms of the geographical spread of income and consumption could be quite significant as a result of this. So that's the miracle of mobility, and I just want to say a few words on manufacturing. Yael has already talked quite a lot about manufacturers, and I think generally most of the technology that we expect to see in the future is already there, and it spans multiple stages in the value-added process. Just summarizing where we see the implications are in terms of labor market, value chain, and production location, I'd say the industrial robotics that Yael has talked about, just looking at the historic perspective, we expect a lot of it to continue, but potentially increase further productivity and the flexibility of production in manufacturing. We're also expecting a potential shift of manufacturing towards more capital intensive location and to location where the skill level is slightly higher. And then there's another technology that I just wanted to talk a little bit about, which is 3D printing or additive manufacturing, that has similar impact to industrial robotics in terms of its highly automated process and the requirement for high-skilled labor and less need of labor, as well as the shift of production towards higher capital location. But I'd say the difference here is that we are likely to see a different implication in terms of productivity, because overall 3D printing do not have the scope of economies of scale that we do see in industrial robotics, and therefore the main concentration of this is likely to be in small-scale productions, and production is much closer to the consumer. So in that sense, it is likely to be quite different. And then when you look at Internet of Things, that even is more different to the other two, in the sense that the fact that it is going to increase or improve communication between different machines is likely to enhance value chain trends that we've seen already, rather than reduce them. So if you like, reversing the potential reshoring trends of both industrial robotics and 3D printing in the future. And this is why it is very difficult for us to tell how technology is really going to impact the location of production as well as labor in the future. So before I continue with that theme a little bit more when talking about trade, I just wanted to say a few words on services. Obviously, services are going to see a big impact from technology, and both Jens and Laurie alluded to that already. And I really just want to say a few words on financial services, because it is likely to be the sector that is going to be one of the most affected by technology, partially because it is more, if you like, more eager to embed technologies and other services. And when we look at technology within financial services, there's really such a wide range of different types of technologies there that I just wanted to focus our minds a little bit at what our clients are telling us that is important at the moment. And they're really focusing on analytics and big data and application programming interfaces as a type of technologies that they're looking to embed most. And when you think about what that could mean, I think there's just really, apart from the obviously higher productivity, the key impacts are lower transaction costs through more efficient operation, as well the enhancement and the broadening of the benefits from financial services across different consumers, as well as the introduction of a broader range of financial services. So it's all great in that sense. And we could also, to some degree, as a result of that, see the reduction in general saving in some societies because of this, the reduced need for safety net. So I just want to spend just a couple of minutes on trade and just look at the different technologies around it that I've already talked about, and just talk you briefly through some of the analysis and modeling that we've done on the implication of technology on trade, just to finish off. We really group technology into three buckets, if you like. The first bucket that has 3D printing, industrial robots, and machine learning and AI are the capital-intensive groups that is likely to potentially shift production back to where we have higher skills and where we have more capital. So if you like, it's more of the reshoring trend. On the other hand, we could see the Internet of Things with with a lower cost of coordination of production, extending supply chains and value-added trade. And then the third bucket, if you like, is the autonomous vehicles, where they're effectively going to lower the cost of transport, so they're just going to increase trade regardless of whether it is supply chain related or whether it's just final goods. So it's just goody-goody for everyone. And you will have heard me talk a little bit about value chains already, and I think I just wanted to give you this nice picture just to emphasize how integrated and how important is value chain in terms of the overall trade picture. So we've got Boeing here and looking at all the different parts of a plane and where they come from, and as you can see, it's not only that it comes from different countries, it actually also comes from different regions. So the implication of technology on supply chains and the trend in supply chain, it is really important in order to try and understand how technology is going to impact trade. And what we did, as you always do, is when you don't know, you create scenarios, and we created 5 different technology scenarios. We looked at a scenario where we have the technologies that encourages reshoring, dominate a scenario where a technology that encourages an increase, expansion in supply chains dominate, and we look at a scenario where we have a reduction in transport costs and a scenario where there's no change in transport cost, and we compared these 5 scenarios to our base scenario where there's essentially status quo and there's no change. And as you can appreciate, in terms of the overall trade volumes, there is a big difference depending on where you think technology is going to go. If you look at the dotted line there, and if you look at the third scenario from the bottom, that's really the status quo where growth in trade is just driven by economic growth, but everything else above and below is really depend on where you think trade is going. And I can see that you will still need to guess which scenario is which in these slides, but that's fine because as you can probably imagine, the yellow line just looks at reshoring with no improvement at technology, whereas the top line looks at value chain expanding, technology dominated with lower growth, and everything else is in the middle. Then just giving you a little bit more in terms of the numbers compared to the baseline, you can see that there's a big impact looking at which part of this technology we will see. And just another way of looking at it really is when you look at global trade as proportion of world GDP, you could see that we could actually see a doubling of global trade as proportion of GDP if we look at the very technology trade-friendly scenario, but we could see halving of that if we look at the more reshoring side and no increase in transport costs. So no one knows really, but the implications are quite significant in terms of where trade is heading, and that's even without thinking about the politics and the political trends around it. So just really to summarize and maybe to just add a few more questions to what I've said already, I'd say it is quite obvious that productivity is influenced by technology, but as we've seen quite recently, this is not the only thing that is impacting productivity, and we need to understand why. Even with the emergence of new technology, we are not seeing the expected impact on productivity as a result. Yael mentioned labor markets already. There are only two things I wanted to add to that. One is the importance of skilling and the challenges that we have in preparing the labor market to new technologies that are increasingly going to emerge more rapidly. How do you make sure that your labor force is ready to that and make sure that your training programs remain relevant? And then related to that, but even more of a challenge, what we find with work in the UK and with work with our clients is that actually when it comes to skills, it's not just the technical skills, but a big problem that we have is with management skills. So how do you get management ready to embed technology in a way that works? And one of the things that we've seen so far is that we've had many instances of management that was not ready and invested a lot in technology only to find that that didn't work, and now they're very reluctant to invest further. So one of the hypotheses that we have in terms of the fact that investment is so low at the moment is that although we also obviously have a lot of uncertainty, especially in the UK, but beyond the uncertainty around Brexit and everything else, actually management are finding it difficult to think of how they can invest and take advantage of new technology in a way that they can save face and actually do it effectively, given a lot of the, if you like, bad investments that we've seen going on earlier on. So this is a real issue for us in the UK, and I hesitate to guess that this is definitely an issue elsewhere in the Western world. There's also competition policies that was mentioned by both Yael and Laurie, and how the new technology is creating monopoly power due to strong network effects, and the new business and organization models where we have larger companies and more international companies actually dominating and becoming more successful at the expense of others. And finally, the one thing I wanted to mention that we haven't really talked about so much is developing economies and the implications that we could have of reshoring, taking away the opportunity for development from a big chunk of the emerging or developing economies, because they will no longer have that industrialization ladder that they can use. So a lot more potentially to discuss when it comes to the impact of technology.
Thank you very much. I think I might ask one question each before we go to the audience. So for Jens, you mentioned the superstar pattern, and you said it makes sense for some digital companies that have obvious scale to them. Is there a reason you see the same pattern in European manufacturing? Because it didn't seem obvious to me that that would necessarily follow the same pattern. Is there some underlying reason why that same superstar pattern exists?
I mean, so that there is productivity dispersion across firms, even within narrowly defined industries. I mean, that sort of has been known, and it's kind of reassuring that we do find that in the data. And so why we see this superstar pattern, I mean, we weren't sure if we're actually going to find it in European manufacturing, so we were kind of agnostic what to expect. But we do find it, as I said, not in all, but in some industries. And I think the underlying channel could just be, I mean, the most productive firms tend to be the most profitable firms, and the most profitable firms have the most resources to spend on R&D, and that will kind of cement their position, you know, in the distribution of productivity, and potentially even have a higher growth than the normal firms or the average firms. So in a sense, it makes, there are channels and theories to explain and rationalize what we find, and but so far, I mean, there wasn't so much empirical evidence on this in European manufacturing, but now it exists.
Okay, thank you. And for Lori, you'd mentioned how data is becoming important for business and how that's being put in software. Do you have a sense of whether we have the data in the right form? Because my understanding was companies may have the data, but it's scattered, it's not in one place, it's not in the right form to get it in the machine. Do you have any sense of whether that's still a restriction, or have we made progress on that, or is that still a consideration in many places when engaging with software and these type of things?
That's a good question. I think, so what I was referring to was estimates of, I think it was taking as a given that this data is there and can be accessed and is being used increasingly for making decisions. And I know our statistics agency had looked into, had enough, felt that there's enough evidence of that. But in terms of some individual firms still struggling with that, I think it's a very good point. I know even it kind of, I think it may speak to what you were talking about too at the end, where firms are spending a lot of money on, or have been at least, on things that they know are the right thing to do. And they're told that they're very effective, but don't often know how to leverage the technology once they have it. But I think the way that, in the work that our statistics agency has done, has gone through from various types of different firms, like a small business or an advanced manufacturer that has all these sensors now that are in their equipment that they can read, and that provides data almost directly, and that is there. So it's an asset that can be drawn upon, but I'm sure there's still a lot that could be.
Do you have a sense that central banks are at the leading edge? Are they leading or following in the use of data within either the economics community or the business community or other?
Well, we've always used data in terms of our making data-based monetary policy decisions, but in terms of, I think there's a lot. I think there's a lot more that can be done to use more data that's in our organizations already that's not being used, and that this technology will facilitate us doing. But I think, I don't know if I would go as far as to say central banks are leading on that front. I think businesses would be ahead of us, is my guess. But we're certainly investing a lot in trying to kind of use that same digital approach to to the work that we're doing.
And then for Yael, did you have any estimate of when you might hit that stage 5 autonomous driving? Is that unknowable, or is that 2030, or is it anytime soon?
As soon as possible, ideally, but I think it is quite far. To be honest, when you look at the numbers, we're looking at adoption of maybe only 5% by 2030, so it is quite minimal, and there's a lot that needs to be done in terms of the infrastructure, in terms of the telecom infrastructure around it, as well as the security concerns around it, and there's a number of legal infrastructure and regulatory infrastructure that you need to embed as part of it, so I think we're unfortunately a little bit behind.
And then we also talked about fintech and adoption there. We didn't really get into blockchain or any of those technologies. Did you have any thoughts? I know sometimes those get lumped together unfairly.
Yeah, I mean, actually, one of the things I wanted to talk a little bit about in terms of the data is actually when we look at where the advances are, a lot of them actually around the health, and how you can use health data to improve diagnostics and make health service much more efficient. So I think if I think about the UK, where the advances are most and where the excitement is most is around the health area, and just as the health sector, but actually also in financial services sector, one of the key issues that we have is the confidentiality of personal data, and how you can convince the populations this is in their own good and that they can trust the use of personal data, and that's really one of the key things that we need to overcome.
Okay, thank you. Why don't we open up to the audience? We'll do a set of 3 questions to start off. Kathleen?
Thank you. So this is a question for Jens. Again, to talk about the differential between the superstars and the laggards. Can you comment on the possibilities of these laggards to actually close the gap or reduce the gap? And if not, do you think over time the composition of superstars will change? We've seen over decades that indeed there are major changes there. And if I may indulge into another question for Yael, you mentioned the value change. To what extent do you think that with the technological change, we might see a fundamental shift in the supply chain so that manufacturing is in fact getting much closer to the consumer and to adapt more quickly to changes in consumer demand?
Thank you. First also to Jens and following up on Kathleen's question. I think there has been a discussion a little bit in the US data whether the superstar firms are actually the super large firms or just, small, very efficient ones. Any sense from the European data also on the time dynamics, because in the OECD data it seems like a lot of the racing ahead of the superstars was actually before the global financial crisis. After that it seems to have slowed down, so it would be interesting. Second point, and maybe more a compliment to our Canadian colleagues. So we looked at how much of global trade is already affected by digitalization. Which seems like a simple question. Turns out there's very little data. Canada is one of the few countries that has done something on that and helped us to identify that about 3.5% to 6% of global trade are already in a very meaningful way affected by digitalization. That might be a small or large number, but in any case, it shows we need more data, and Canada is on top of that, which is very good.
I have two government questions, and whoever wants to tackle them. One is on subsidies and government spending for autonomous vehicles. Every presentation I hear has that component. And I try and think of other areas that have had massive output gains and have used technology, and the one that always comes to mind is fracking. Lots of complex data, lots of complex activity, horizontal drilling, zero government involvement. So that's a question as to where that always comes to in vehicles. The government question is on, and Yael alluded to this, is who owns the data and what protections do I get from the sovereign? So as cameras go up all over and the sovereign can track me, that's inevitable. The question is, what protections do I get for them fishing through that to do things?
Shall we start? So thank you. Yes, so I mean the question about the European superstars, who are they? Are they large? Can the laggard firms catch up? So I must say, so what I can say for sure that the European superstars that we find in our data are not typically the largest firms. So that may actually be a difference to the US story with Amazon, Google, and so on. Well, it's actually the same. Okay, it's interesting. So, but I mean, there is obviously a correlation between size and productivity, but it's not really necessarily that only the biggest, largest firms are the superstars that we find are the ones who are most productive and have the highest productivity growth, even though that may differ a bit across industries. So, the possibility of laggards to catch up, that's obviously a very, very important question. And I'm not sure that I have much to say about this because, I mean, the time span that we have there, I mean, it's still relatively short, so we don't see many dynamics of former superstars now falling behind or being taken over by other firms. I mean, I am a bit concerned about this because in the US, I mean, at least that's how I look at the data, that the really large superstar firms that we all know, that they are just filled up with retained profits, and every competitor that looms somewhere on the horizon, a small firm, they're just gonna, acquire, like Facebook with WhatsApp and so on. I mean, and this is something that obviously will make it very difficult for laggard firms to actually reap the superstar status. I mean, my sense would be that maybe that's even a bit easier in manufacturing because there's just more product differentiation and you don't have these network externalities that really cement your superstar position in these internet markets. But this is again a bit speculative. But obviously, I mean, this is probably one of the most important policy questions that we need to think about. What instruments are key to have more dynamism in competition and in those markets?
So I'll just answer the question on reshoring first, where I think you're right. When it comes to capital-intensive technology, we could see more of the reshoring, but the other thing that we need to think about it is when we look at in technologies like the Internet of Things, where we could actually see more dispersed production, not just because we're going to look at locations that are potentially having cheaper labor, but actually what you could see is centers of excellence that are emerging. So even with capital-intensive production, you could still see the center of excellence, just like the Boeing pictures that I showed you earlier, where you will have an increase in trade between these center of excellence, and that's the only thing that it would make is more efficient and productive production. So I think it could still work. On government investment, from the little I know about fracking, and I don't know much, I think my understanding is that it requires relatively low and flexible investment, and therefore it's quite different to the longer term capital good type investments that you need for automotive if you like, the mobility revolution, and it's probably a little bit more akin to what we've seen with 4G or internet technology, where it is effectively a public good, where you would not have the private sector investing in the early stages because the reward are relatively small until you have the full network in place. So it does require government intervention. And finally, on who owns the data, this is a brilliant question. It's really, really important. And my related question to that is who benefits. So I think we would potentially need to see a model where us users actually get some of the benefit of this monopoly rent that these big businesses get in order to be able to entice us to part with our data and not only get part of the money, but we actually also have to have some control and share the control of that data.
Yeah, I was just going to make a similar point to that. I think countries are certainly thinking about it. It's a big question. Is if the primary source of monopoly rents in the digital age is data, then how do we? Same the question you asked: who owns it, and how do we share it? It's what you're saying. Some examples. Think of like some ideas that have been put out there about giving users control of their data and having firms even pay users for their data. There's some ideas that are being put around by companies for how you can do that, or sorry, by countries. But I think it's definitely some more conversation needs to happen around that, and it ultimately becomes a kind of a societal question.
Should I ask a follow-up on that? Because there's some economics here that there may be Google or Facebook may earn $5 a month on me. I can't even buy a beer in Munich with that. But because they have 1.7 billion people, they make a lot of money. So there's this very scale distribution. Mm-hmm. And so me getting the rent for my data is a beer from Facebook. But to me, that's different. The question I have is how my data is there, how am I protected against it being used against me by the sovereign, by the government? I mean, the extreme is in China. I can't get on a plane. But I mean, in everyday life in the West, where do I get the protections from the data, my digital exhaust being used against me?
By the statistical agency, you mean, or the government having access to it?
I'm on a toll road and I get an email at the end of the day and I have a $1,000 fine because they knew how fast I was going.
Yeah, you shouldn't be speeding. That's right.
I just added there's definitely an issue with the selection bias here, in the sense that what you get is data from a specific group that is likely to benefit, and that's not going to reflect the whole population. So we do need to be able to entice everyone to do it. Otherwise, when you're trying to look at averages and when you're trying to use it for diagnostic, etc., there's always the issue of those that are worried that they'll have higher insurance premiums as a result that are not going to participate. Yeah, it is an issue.
I guess the only other thing I would add is, because I think we face this struggle, because if we think about, even when we talked about on our working group some ideas for what would help to have better data, some of it is allowing statistical agencies more, kind of reducing the tape around administrative data, which would help them to be able to draw on that. But then there is the trade-off that you want people to still feel that their things are anonymous and that they're not, that their privacy is being respected. And so those kinds of trade-offs have to be taken into account as we're trying to, draw more on data. So I think it's a really real concern for people.
Maybe I'll bring Jens back in with one question. So there was a book called The Master Algorithm. It's written by Pedro Domingos, who's the author. And he talked about how they've whittled different types of algorithms down to only a few. And these different types of algorithms tend to underlie some of the big tech companies, like Google's algorithm, where if you click on a link, it gets voted higher in the search mechanism, is actually a dominant algorithm. That will yield better search results than a list, which is how other companies did it and these type of things. And at least that's the premise of this book. And so it becomes self-reinforcing. So the more people that use Google, the better the search results get. The better the search results get, the more people use Google. And that's been part of this winner-take-all market. I was just wondering if that showed up in your data in any way as well, where there are just algorithmic methods when you get enough data that are self-reinforcing and things of that sort.
Yeah, well, I don't know of that particular technology, but I mean, my concern, generally speaking, is because so far we have studied the industrial robots and therefore mostly the manufacturing sector, because that's where we have some data and then we can collect the empirical evidence, and I mean, we can see kind of what came out of it. And then I'm always asked, so what's going to happen next? The next wave, and what you describe is probably the next wave of technology. And probably the one concern I have is that most of these technologies that you're talking about will hit the service sector, and many jobs in the service sector. Algorithms taking over work in insurances or even in banks or whatever, right? And there, I mean, the issue is when I compare it to our results, I mean, in the German manufacturing sector, it's very well organized, right? I've talked about the trade unions, the works councils, and they kind of found solutions so that nobody essentially, at the individual level, lost the job, right? When I think of the service sector, I mean, that's large and very unorganized, and therefore I personally would expect that the type of technologies that you're describing will have a stronger effect, and probably will have the same pattern that we've already found in the data, but just stronger, so more disruptive, more stronger, and also in terms of the income distribution, even to a higher extent than what we found already. So that's actually my biggest concern. I agree with that.
Yeah, there was a old cartoon that started in the 1960s, 1970s called The Jetsons. I don't know if anybody's seen this. This is George Jetson. He's the main character. He's a cartoon character. And this is set in the future. So this cartoon is a futuristic view that came out of that very optimistic period. And so he had a flying car. He had a robot that made him dinner. And he worked for Spacely Sprockets. And his job was to go in, and it was a digital index operator, which means he pushed a button. And there's one episode where he came home and he's like, it was a really hard day at work. Spacely made me push the button 8 times. I have to take a nap. And so maybe that'll happen in the service sector too, but we will see. Other questions from the audience?
So for Jens, so I was kind of intrigued by the data on net job creation in, here versus the US. And it seemed like that was a function of displaced workers staying with the same firm versus some other form of flexibility in the absorption in the labor market. So so the question would be sort of, is that almost exclusively what's going on?
Yes.
Okay, you answered that question. And for Laura, you didn't mention anything about digital central bank money. Right. When Canada's one of the leading kind of central banks, so if you have any comments on that. And Don, I just told Steve, I'm not impressed by any of this until I get a Jetson car.
Or the robot. I'll take the robot. Rosie?
We start right away. So exactly. So that's exactly what we found, that at the individual level, the individual worker who was kind of exposed to this new technology, in the statistical sense, nobody lost the job, right? So, I mean, you have pretty detailed information about the type of occupation, the type of tasks, and we've seen former machine operators being turned into service clerks or logistics managers or whatever, but it happened at the same workplace, and they were retained, and they just stayed with the firm, probably for the existence of firm-specific human capital, and then when they retired, then the vacancy was not filled, and so probably it was just what robots did was kind of to block the entry into the manufacturing sector for young workers, and they had to start their career somewhere else, and they started in the service sector in pretty advanced services. That's kind of, in a nutshell, the story.
So the wage effect was, I mean, did they receive pay cuts immediately, or just no raises for?
That's more of the latter, right? So I mean, so the jobs were stable for the manufacturing workers, but let's say the medium skilled, so the typical profile that you have there, not college educated, but completed apprenticeship. So they kept their jobs, they moved to different occupations, but they didn't receive wage increases, right? So they were kind of stuck, and all the additional gains that came in, they just stayed with the firm in terms of higher profits, higher productivity, but they didn't hand it out to the bulk of workers.
Yeah, so I talked about just the on the real economy and the prices side. that's where our work. So when we just in terms of a practical perspective, in terms of the way that that our working group was focusing on those aspects of digitalization, and so there's other parts of a great number of other people who are thinking about fintech and central bank digital currency. But certainly, I mean, I would. It is very top of mind right now, and has become certainly more top of mind as we see how quickly the private sector and some of the innovations in the private sector. So there's a lot, of course, as you would know, a lot to be thinking about, and we're doing a lot of work on trying to understand what the monetary policy implications are, kind of the utility of these digital currencies, and there's like the three things that we would normally look for in a currency, but there's also the utility of it and what, in terms of how the population will use it if this kind of the emerging population is so much more connected digitally, and what that means. And then on the monetary policy side, how is it affecting our frameworks? What about in a crisis? So all the different ways in which more digital currencies can be affecting the system, and then new things I think that we wouldn't have had to think about so much as central banks, like privacy, if we were to go. So if there's more of these digital currencies, and if there's a central bank digital currency, how do we take that into account? Normally we're thinking monetary policy and financial stability. Privacy is not kind of one of our top things that we're dealing with, but this would be something that would be more. Something that would have to be thought about if we were under the scenario of central bank digital currencies, and then also the resilience of it. I know my colleague who works in this area talks about how there was a power outage in Ottawa, and for I think, I don't know how many hours, 50 hours or something, there was no power, and the first thing on his son's mind to call was to say, the internet's not working, is that the router's out, and so what am I going to do? And it wasn't how am I going to get food, or I can't. Again, it wasn't any of the kind of basic functions that we might have thought about before. It was just how am I going to, I'm not connected right now, and how am I going to get connected?
Use the wood-burning internet.
Yeah. So, but it is something that we're doing a lot of work on, and at the central bank, yeah.
Maybe I could bring Yael in with one other question. You'd mentioned a lot of these technologies that have to go through the corporate approval process. I wonder if it's easier for a manager to approve a technology that affects the production line than to approve a technology like AI that might affect the number of managers. In other words, is management slow to adopt technology that hurts management? And it's like, I would like to have a magic 8-ball where anytime there's a meeting scheduled, it's an AI 8-ball, and I pick it up and it says, should I go to this meeting? Yes, no, try again later. But can you apply the technology we're talking about, the data analytics, to the management process itself? And isn't that where some of the real benefit would be? Yet it could be slow to be adopted because it requires the adopter to put himself out of business.
So I think that's a good point, but I'd say just looking at the private sector, not necessarily public sector, but I'd say private sector tends to be relatively ruthless in the sense that ultimately you're chasing profits, and if someone is not needed in a certain role, it's much easier. There's a much easier transition generally, but especially when we look at services, I think when we look at technologies and services, what we are likely to see is a replacement of tasks, but not necessarily replacement of jobs. So generally, I wouldn't necessarily see technology reducing jobs, but actually the need to reshape what people are doing, with the exception of certain middle management jobs, or maybe things like radiologists and stuff where you really just interpret data. But overall, just touching on Jan's points earlier on, I think that actually the impact on service sector in terms of the service sector employment may be lower. I'm less worried about that, because I think if you think about retail and the retail sector, so far we've seen a big loss in jobs, especially in countries like the UK, but unemployment is very low, and the reason is that all of it is shifting to hospitality and shifting to sectors like social care, where the scope for improvement in productivity and the scope for the usage of technology is more limited, and the desire for customers to actually purchase the experience rather than something that is more efficient is relatively high. So I'm not that concerned about the loss of jobs in the labor market in services at the lower level. And in terms of the management level, I think we will see a shift and a redesign of that role.
Maybe can I just throw it open to the panel, then yes.
Maybe if I can respond. So I'm also not concerned when it comes to the overall number of jobs, also in the service sector, because as you said, I mean, there will be some jobs disappearing, other jobs, for example, in healthcare, where there's a huge number of additional jobs. But I mean, I'm concerned that the whole scenario will be more disruptive than it was in the past, right? Because in the response to robots in the manufacturing sector, it was not disruptive at all, because nobody actually lost his or her job, right? And the concern would be that in the service sector, which is less organized, that the whole thing becomes more disruptive, and obviously then this will create a high demand for retraining, right? Because you cannot become, if you are working in retail, you cannot start as an elderly care worker tomorrow. You will need retraining, and we need the right institutions to provide this type of retraining. So that's my concern, not about the overall number of jobs, but about the degree of disruptiveness, so to speak.
Maybe we could stay on that for a second then. Is the panel confident that we have the retraining institutions, or that we're close to having the retraining institutions anytime soon to do these things that we're talking about?
Well, what I can tell, I mean, let's say in Berlin, in the policy circles, I mean, this is kind of the smallest common denominator, that we need more retraining, and I haven't met a single person who would disagree on that. The delicate issue is who's going to pay for it, right? So some think of retraining that basically the workers have to do it themselves in their spare time. The other extreme view is that basically everybody, all costs have to be borne by the employer, and I think that's kind of the discussion we need to have, and we're probably making small steps in finding a compromise in that respect.
So I probably would maybe give the example more of the UK that I'm closer to, and I say that Germany is probably the top in terms of the good practice model when you had the retraining, the general attention to skills, etc. for manufacturing. But if you look at the industrial transformation in the UK, and we're obviously paying that price at the moment, we didn't have such a smooth transformation from mining and the declining industries in the UK, and what it left is big scars, big geographical scars and regional scars in the UK that we're still paying the price today. So I don't think we're going to have more of an issue now. I think there's more of a focus of needing to address it now. And I also think that the good thing about a lot of the services is that actually you don't have that much of a need to retrain as you did with manufacturing and with heavy industry, because when you think about things like retail and quite a lot of these areas are actually relatively low skill and quite sociable skills that are very transferable to other service sectors.
Hopefully.
Yeah, I agree on both of those things. So I think in terms of the kind of what we can, whether we have the kind of programs or institutions there for reskilling, I think is a really important question. I think the history is mixed in terms of our how successful certain things, certain approaches have been. I agree, and I think Germany does stand out on some of the approach to reskilling. I think there are certain examples, and countries would do well to looking at those and trying to kind of follow the best practices on that. I know that in terms of the international policy circles, there's a lot of talk about this, and in the G20 last year under Argentina's presidency, there was an attempt to kind of take stock of all the ways that you could support reskilling in the future of work, but it's there's a big list of possible things they could take, and I think there's still a lot of work to be done to figure out what are the ones that are most likely to work and under what situations.
Yeah, I mean, if I can add one thought about this, I think one reason why Germany digested the technology shock maybe a little bit better than the US is actually because of this apprenticeship system we have, which is kind of, for many countries, seen as a role model, as far as I see it, because it provides general training to non-college workers, right? And this is kind of what you need. If you shift occupations and you switch tasks, you need not on-the-job training, but some sort of general skills, and this is kind of what the apprenticeship system provides also to non-college workers. So I think this is probably something that works pretty well in Germany, I agree.
So if I could ask, why have other countries, including the US, not been able to do this? Because we've seen the apprenticeship system, we've seen the Mittelstand, the idea of it for a long time, and we just don't do it. And I wonder what the institutional rigidity is, that the idea of an apprenticeship system, when you think about it, makes perfect sense, yet it's very slow to be implemented. Maybe it's the other institutions that it's competing with, whether it's the track or not, but I think that's right. Somehow that...
Yeah, I mean, I think of it, I mean, it's a part of a bigger corporatist system, right? So I'm not sure that you could just easily introduce basically the apprenticeship system into a labor market where otherwise trade unions play no role whatsoever. So that probably will be the challenge.
And maybe I can just add from the UK side, because obviously this is something we've been looking at, is one of the things that you have in Germany that is very strong is the role of industry and the role of prospective employments to group together and train and be involved quite heavily in the qualification, in the training, and there's a whole direction, whereas at least in the UK you have a much more dispersed industry and it's proved much harder to put them together with this common goal, because there's always the fear that you're going to train and invest and they'll go somewhere else. So it's a different culture, and we haven't managed to get that mindset among employers in different industries to emulate it.
Yeah, I think that cultural difference may be a big part of it. So we're running short on time here a bit. We have time for a few more questions from the audience. And so maybe what we'll do is we'll take one more round of questions, and then maybe I'll just ask the panelists for any final thoughts. We'll go down the line, and then we'll conclude for the day. But let me open it to the audience for anything we have not yet addressed.
When we look at the digitalized economy, a lot of business models offer services free of charge, like Google and many other, Facebook, and at first, at least for basic product. Yeah. Isn't that a bit, I don't know if anyone of you has thought about how to measure this in terms of GDP and in terms of productivity. Obviously, I think my impression is these business models are very, very important. Yeah, they play a very important role in our economy, but because they're free of charge, I don't know if they show up anywhere. Yeah, and how you take account of these in terms of economic growth, productivity, and maybe even inflation.
Any other questions? Why don't we take that one, and then we'll do final thoughts.
Okay, yes, so that was what the work that I was referring to that the Federal Reserve colleague staff had done was trying to do that, looking at free kind of services that are provided and what it would be like if they were taken into account. So they had, it's one of those things with, just like when you're trying to go through statistics and how they're compiled. They're not always the details behind it, but I have, so I have to look at what was done. But so there they use proxies of household utilization of broadband and wireless networks and cable networks to try to get indirect sense of what's being, how much is being used, and then paid, so services that are provided through other means, and then try to get proxies of what those would be, both in terms of so looking at the kind of the quality of changes in the quality of the network services and the intensity of how they're distributed. But I don't have a very much more straightforward answer for you than that, other than I know that that's what this work did, and they do find that when you take those into account, quality adjusted prices have been falling even more than we would have measured, and the productivity and growth slowdown that we've seen in the U.S. wouldn't be as pronounced if you included those free services. Yeah.
Why don't we go final thoughts?
I don't have much to say on that data question.
Do I have any final? Do I have final thoughts? We talked about a lot. I think it's, one thing that strikes me is how it can kind of sound abstract, or we talk about all these things and they're hard to really put your finger on, and we're so used to using our conventional tools to look at the economy, and we think about a lot of our models that we use are using conventional sources, and it's not always clear how much, if you need, these other sources are interesting, but do they really change anything? And I think that that's really the key question that we need to keep asking ourselves and doing more work to better understand how much things are changing more than what we're measuring right now. And I think it's really exciting, the work that statistical agencies are doing, and I hope that we'll continue to better understand, and then we can take these into account with monetary policy.
So I just wanted to say something a little bit more on the optimist side, that if we actually look at technology and the vast array of new technologies that we've seen introduced, it's actually quite frustrating to compare that to the way productivity has been performing in the last, say, decade or so. But I think we really need to take a step back. And for me, if I start thinking about when I started work and there was no internet, and how we did everything with working papers and writing, and how we advanced since then, I think we need to bear in mind that there's time that takes for technology to really be embedded in production of services more than manufacturing, if you like. And I think all these new technologies of AI, etc., will take at least a decade to actually show up in the data. So when it comes to the real impact on the economy, we haven't started seeing the impact of all these new technologies that we're seeing at the moment.
Okay. Okay, my final thought. So I mean, in my presentation, I tried to stress the income distribution a lot, but I mean, there weren't that many questions about this. But I think this is going to be the key challenge, right? Because again, it's not that everybody has automatically benefited from these new technologies in terms of real earnings. So it's like with globalization, it was like a benefit in the aggregate for the aggregate economy, but not necessarily for everybody in the economy. So there were large distributive effects, and sort of we see political backlashes already, right? In many countries where kind of the losers of all of this are not willing to swallow, right? And I think, you know, if these distributive effects in the next wave of technology, if they will continue, we're going to face even bigger problems along those dimensions. So I think we really need to come up with solutions how to spread the gains of this technology wider in terms of higher earnings for everybody, right? And so therefore, I mean, there are some models that say we transform Germany or Europe into a continent of shareholders where we all have ETFs and earn automatically from all these technologies, and we achieve this by giving kind of tax incentives for everybody to save and buy shares, right? The problem is that 40 to 50% of the population don't save at all, right? And they don't respond to these type of tax incentives. So I would kind of encourage to think of kind of more full-blown measures to tackle this issue, be it with a sovereign wealth fund where the state saves on the behalf of the bottom 50% of the population, or along those lines. So I think these are the type of discussions we need.
Jens, Lori, Yael, thank you very much. Please join me in thanking our panel. So we will conclude there. Let me just mention on the GIC website, interdependence.org, you can find some of the details here, as well as some of the upcoming events. Also, let me thank Jill Fornito, who's the GIC Executive Director in the back there. If you have any other questions, please see myself or Jill. And so I'll just conclude by going over what I learned today. So we thought about how we've had long business cycles. However, we discussed macroprudential policy as well as monetary policy that could elongate those cycles. We spent quite a long time on tariffs and trade. This isn't the first time we've seen tariffs, but it does seem like this time is different. And so hopefully we've made some progress in understanding how that's different. We looked at debt, and by just about any measure, debt is high, but interest rates are low. And if they stay low, we can go from there. We looked at the yield curve and why there are differences with that financial market signal. And we spent quite a long time on the labor market and profits, and there are numerous developments that we can consider there as well. So that's what I've taken away. I hope you take away something, and I hope you continue to converse with the folks you've met here today, because that is the point of the organization. So thank you.